The first stock we're going to talk about today is Finning International, and this is a top pick from many experts. One, because it has strong fundamentals, and if you would run a technical analysis, it would score very high. And third, because of its strong correlation to copper prices. So what does the company do? Well, essentially, it provides and builds equipment that are used by mining companies. And right now, it is benefiting from strong commodity prices. With a strong order backlog and growing cash reserves, Finning is seen as a long-term hold with more potential upside. The one word of caution I want to throw at you is that this is a bit of a cyclical stock. As I mentioned, it has a strong relation to copper/commodity prices. When things are good, stock is good, and then when commodity prices fall, the stock also falls. So if you're interested in taking profits from capital gains, you can try and time your buys and sells, although I'm not a fan of trying to time the market, but just throwing that out there so at least you're aware of it. The good news for dividend investors is that Finning's board recently approved a 10% increase in their quarterly dividend to 27.5 cents per share, making this the 23rd consecutive year of dividend growth. And that's what I love to see as a dividend growth investor, the longevity of those dividend increases and how much that dividend is going up on a year-over-year basis. So how is the company able to get this type of dividend growth? Well, if you look at the underlying fundamentals, the company just secured over $700 million in new equipment orders back in April, including contracts with copper mines in Chile, oil sands in Canada, and data centers in the UK and Ireland. The company also has a very positive outlook when it comes to Western Canada, with expected increase in activity in the energy sector and a strong demand for product support. As you know, Western Canada is a powerhouse when it comes to oil sands and mining. So there is that correlation. As long as those companies are doing well in terms of mining, Finning gets to benefit by providing for that equipment. However, if we take a look at the last 10 years, it has underperformed the market. This just goes to show you that if you are picking up a stock, and when we talk about value, it's so important to zoom out, not just 1 year, 3 years. Take a look at 5 years. Take a look at 10 years. Are you seeing this cyclical concept from a stock price perspective? If so, then you want to be very careful when you are timing your entry points and opening a position into a company like Finning or something very similar. Now, if we look at the pandemic during 2020, the earnings dropped 31%. However, if you look at other years, earnings are up by double-digit growth. So when it comes to these cyclical stocks, the point is you want to zoom out, get a good 5-year view and a 10-year view to make sure that when you are buying into a stock like this, that you understand the macroeconomic factors. Now, if we look at, for example, last year in terms of revenue, Finning generated $10.5 billion in revenue, resulting in a 3-year growth rate of 15%. They have maintained a safe and growing dividend. The company has paid growing dividends for 22 consecutive years with a sustainable payout ratio of around 25%. And that's what I'm looking for as a dividend growth investor. The ability to grow the dividend over the long haul and maintain that sustainability. That's where that payout ratio is so important, that can that dividend keep growing? So to summarize, Finning International is a cyclical dividend stock with the ability to generate profits of north of 10% when years are good. Or long haul, you may see those peaks and valleys, but as an investor, you want to maintain that long-term outlook when you're looking at a company like this. Now let me show you firsthand of how I actually run my due diligence model, so you can see that I'm not just looking at surface numbers to see if it's a good pick or not, because I want to invest my money for the long term. What insights can I really gather before I put my money on the line? And the spreadsheet that I'm about to show you, you can download a copy for yourself. Just visit the link in the description down below. All right, here is my handy dandy financial due diligence model. I have my stock pick right here, Finning International, and I have some key metrics that I'm looking at to see if this makes sense or not. I had the current price, which is roughly around $36, and it's trading closer to the 52-week low versus the 52-week high, and the dividend is 27.5 cents per share, and it has global employees of just under $15,000 with a market cap of $5.6 billion and a PE ratio of just under 11. It's a fairly traded stock on the TSX with a volume of over 364,000. and it's been around since 1986. And here is where the beauty of dividend tracking comes into play. I have its student history going all the way back to 2012. As you can see, it was paying roughly around 14 cents back then, and that dividend has grown to 27.5. As you can see, it's a pretty reliable dividend stock in terms of dividend growth. You can see it has been fairly consistent in increasing its dividend throughout that period. So if you put down $5,000 into the stock today, that'll get you 136 shares at the current market price. That translates to a quarterly dividend of $37.40. Yield is just shy of 3%. And here is the number that's really important for me to look at, and that is the dividend growth rate. Over 12 years, it is averaging just under 6%. If you take a look at Canada's 12-year inflation rate during that same time period, it was around 2.2%. So it is doing almost 3x better than the inflation rate. And that's a really key comparative for me, that if I'm investing money, is that money going to grow without me doing anything else? And I have the payout schedule. It pays March, June, September, and December of each year. Let's jump right into my second stock pick, and this is Exchange Income Corporation, ticker symbol EIF. And this is a diversified dividend powerhouse operating primarily in the manufacturing and aerospace and aviation sector. This company has a market capitalization of around $2.3 billion, and this is a notable dividend payer among Canada's small cap stocks. So what does this company do? Well, they generate revenue from two main streams, about $1 billion from manufacturing and $1.5 billion from aerospace and aviation. Now, despite some fluctuations, the company's gross profit margin recently stood at a solid 34.5%. Not too shabby considering it's in the manufacturing/aviation space. In the first quarter of 2024, Exchange Income did experience a bit of a dip in its net income. However, its revenue surged from $526 million to over $600 million. That, to me, shows strong growth potential. This is a monthly dividend payer, and it's currently paying a monthly dividend at 22 cents per share, providing stable cash returns to shareholders who love their dividends. Insider confidence is extremely high for this company, with recent insider purchases signaling optimism. So every time I look at a company, I'm looking at, okay, who's buying and selling the shares of the company? I've seen a lot of insiders pick up shares. To me, that's a signal of a good sign, a signal of optimism. However, there is a bit of an area where I'm concerned is when I look at their borrowing and their reliance on high debt. When a company is looking to grow, they will either look at organic options or acquisitions, buying up other companies. Now, if you're buying up a lot of companies, you need money to buy those companies. Two ways to get that money: equity, meaning you sell a bunch of shares, raise capital, or you can borrow from the bank. So when you look at a company that's very focused on acquisition, it's a good idea to pay attention to how are they raising all that capital. Are they raising equity-based capital, or are they just borrowing from banks in order to finance all those acquisitions? Now, when it comes to their current dividend yield, the dividend yields are around 5.5%, and right now it's trading at roughly 19 times its earnings. To me, this is a great option if you're looking for monthly passive income. Not only that, but it's shown its potential to grow that monthly passive income, which we're going to take a deeper dive into when I show you my due diligence spreadsheet. And as they've been able to acquire and tuck in those companies, the company's overall performance has increased, and that's one of the foundational reasons why they've been able to maintain and pay that dividend over time. If we're looking at their full year 2023 results, Exchange Income posted record revenues of $2.5 billion and adjusted EBITDA of $556 million. To me, that's demonstrating its ability to grow even in today's challenging economic conditions. Analysts are expecting growth, expecting revenues to climb to $2.7 billion in 2024 and $3 billion in 2025, with net income expected to grow along the same line. And if we take a look at since inception, Exchange has distributed growing dividends every single month, increasing the monthly dividend 17 times and distributing over $870 million in cash dividends as the end of 2023. It's checking off all the right boxes that I want to see as a dividend growth investor. Yes, I do have a bit of concern regarding their high debt, but I get it. They're using that debt to translate into acquisitions. Now, as long as they can maintain a healthy debt to the margin, I'm okay with that level of debt. If you're looking for reliable passive income that pays on a monthly basis, you have your manufacturing, aviation space covered, this is an option that you definitely want to consider for your portfolio. Now let's check in on my due diligence spreadsheet to see what metrics am I tracking. All right, we have Exchange Income Corporation, ticker symbol EIF, currently trading around $47, so about $3 shy of its 52-week high, and a dividend of 22 cents per share, 610 employees, and a market cap of $2.3 billion, and a PE of 19.33. Now, if we take a look at 2020, about 4 years ago, the monthly dividend was 19 cents, and that 19 cents has now grown into, more recently, 22 cents. And we can see that growth in this chart right here as they acquire more companies, as they continue to, get operational efficiencies from those acquisitions. They will pass on that growth to shareholders like you and I in the form of growing dividends. So if you have $5,000 to put down into this company, that'll get you 105 shares. And that's a monthly dividend of $23 with a yield of roughly 5.5%, but a dividend growth rate of 3.7%. Now, in the last 4 years, due to COVID, Canada has seen some of the highest inflationary period. As you can see, the Canada 4-year inflation rate is 3.5%. Well, look at this. If you had invested into EIF, your dividend growth rate is still outpassing some of the highest levels of inflation that Canada has seen in that same time span. But as you can see, I take all these metrics before I make a decision whether I should add a stock to my portfolio or not. And these are some of the ideas and themes you should also be taking a look at as a dividend investor. For my third stock pick, we're taking a look at Minto Apartment REIT, ticker symbol MI.UN. And I'm a big fan of Minto, and you're about to find out why. They have a great, expansive urban portfolio in major Canadian cities like Ottawa, Toronto, Montreal, Calgary, and Edmonton. And these are prime spots. If you know anything about Canada's real estate or rental market, these are prime spots, making this REIT well-positioned to benefit from the strong demand for apartments in these areas. And these guys have done an amazing, fantastic job with their finances, turning net operating income, which is a very important measure when you're looking at real estate companies, NOI or net operating income. And they've converted that growth into FFO, which is another important metric when you're taking a look at real estate companies. FFO stands for funds from operation. And the reason this is so important that as dividend investors like you and I, the more FFO they generate, the more FFO, funds from operations, they can pass on to investors like you and I in the form of distributions. So definitely want to keep an eye out on that FFO ratio. Plus, they have a very disciplined approach to their cap allocation strategy, which has translated into growth. So as you can see, I'm very excited about this particular pick. One is that you get to benefit from Canada's rental market. So now, instead of paying rent, which is a big cost, you can convert that as part of your equity portfolio and become a landlord, but without having to do any legwork and benefit from Minto's selection of apartments. And I will let you know a little bit of a secret. Right now, this stock is trading at an amazing valuation because it's trading at a discount to its net asset value, meaning the stock price that you are going to pay for is technically less than all the value of its properties related to this net asset value number. Now, as you see in the last couple of years, rising interest rates have been tough. But because of their smart decision-making, what have they been able to do? Well, they've been able to convert a lot of that heavy variable debt into fixed rate debt. What that means is that they have a little bit of clarity in terms of their interest expense and their debt obligation. What they've also done is that they've increased rents on their apartments, which have helped offset that higher interest expense. Now, if you're a renter, you obviously hate when your rent goes up. But on the flip side, if you're an investor, That rising rent is going to take care of more expenses, and if there's more money left over, that goes back into your pocket in the form of a dividend. It really depends on what side do you want to be on. Of course, you can play both sides. You can pay rent to somebody, and then also you can be a landlord by investing in a structure like Minto. Renting has become very popular, not maybe for all the right reasons, but anyways, I'm talking about this from an investor perspective. Why? Because of affordability issues and homeownership. We've obviously seen changes in demographics, and that has led to a shift in preferences. What do I mean by that? Because less and less people cannot go out and afford to buy a home. They don't really have much of an option because you need a shelter. So now renting has become more popular, and more people are choosing to rent across all different age groups, and this trend is likely going to continue. Minto's goal is to provide investors with high-quality, income-producing rental properties. That's their whole business, and that's what you want to get in on if you are interested in becoming a landlord, again, without doing any of the legwork and just collecting your monthly rent check in the form of dividends. Now let's take a look at my due diligence on what the deeper dive looks like. Here we have Minto, here we have the ticker symbol MI.UN. And if you're looking for a low price stock to start building your portfolio, this will only cost you like less than $16, probably less than a combo at McDonald's. The stock price is currently trading closer to its 52-week high, and I would imagine this should trend upwards as interest rates come down, because in a high interest rate environment, companies that have high debt like Minto are terribly hit. But when interest rates go the other way, they get to benefit. The dividend is right now just over 4 cents per share, and again, this is on a monthly basis, and you can see their trading volume. If we take a look at 2018, their dividend per share was roughly around 3.2 cents, and that has grown from 3.2 cents, 3.4, 3.7, etc., all the way to 4.2 cents where it's at today. And now let's visualize this into a nice little graph, and you can see it's fairly consistent, fairly dependable when it comes to dividend growth, and this is just going back 6 years. So if you invest $5,000 into Minto, that will get you a cool 321 shares. That's a monthly dividend of 13.51 and a yield of 3.24%. And if you look at that 6-year dividend growth rate, it's at a 4.64. Canada's 6-year inflation rate is at 3.1. So again, you are outpacing inflation with that dividend growth if you had invested into Minto, and that payout schedule is on a monthly basis. And the next stock we're going to talk about is Thomson Reuters, ticker symbol TRI, and boy, this company has been on fire lately, with the stock up around 41% in the last 3 years. Although we're starting to see a little bit of that market dip, but nonetheless, 41% growth in the last 3 years. Why are they doing so well? Well, let's uncover all that. Recently, they had a very strong first quarter, and because of that growth, they've increased their sales guidance for the rest of the year. Plus, they have ambitious AI plans, like every single company out there that is trying to incorporate AI into their business, but you're going to see why Thomson Reuters specifically benefits. It's no wonder you can see that the shares are currently trading at a premium, but should you buy in? Sure, the PE ratio is, a bit high at 31x, and that makes me a little bit uncomfortable, but let me tell you what there's to be excited about. And Thomson Reuters' business in a nutshell is to deliver the latest news. I might say it's a media company, but no, that's where the CEO will strongly disagree with you, where he said on many different occasions that Thomson Reuters is not a media company. This is now a tech company, but pretty much every other company wants to be a tech company to get that benefit of valuation. But let's keep unpacking the story here. If we take a look at some of the numbers that they're reporting, their first quarter was exceptional, an 8% increase in revenue, reaching US $1.9 billion. And they have 3 major segments: legal, corporate, tax, and accounting. They all saw a notable 10% growth in those areas. And when I look at their strong performance, I can see that this is a testament to the strong business operating model. They've been able to successfully generate significant revenue coming from very profitable licensing deals from their content with AI companies. Their new AI-based products like Legal Assistant Co-Counsel, powered by OpenAI's ChatGPT, has received some very positive feedback. Plus, they're also investing $100 million annually into AI development. So that means not only can they talk the talk, but they can walk the walk and back up that walk with a cool $100 million annual investment, which shows long-term commitment to integrating AI into their offerings. The other piece is that their Reuters News division saw a 21% increase in revenue, largely due to one-time licensing deals with AI companies. Customer uptake of their AI offerings is expected to accelerate in the latter half of 2024 and into 2025 as well. All good signs that I'm seeing so far. I've also seen their customer retention rate, which is at an extremely high 91%. So if we take a look at all that, sustained revenue, their growth to me looks promising, and I can see why this Canadian tech company can actually challenge those big US players. Now let's go take a look at stats for a deeper dive. Here we have Thomson Reuters, ticker symbol TRI, currently trading at a whopping $218 per share, very close to a 52-week high, and they're paying a 54-cent dividend per share. They have global, almost 26,000 employees, and a market cap of over $100 billion. That's a lot of zeros, and a P ratio of 31.41. If we go back all the way to 2008, the dividend was 27 cents per share, and that has grown all the way to now 54 cents per share. What's interesting is when you put this visually, when it was more of a media company, that stock had a decent level of dividend growth, nothing earth-shattering. Here's a little bit of an increase here and there. Now that they've been really focusing on becoming a tech company powered by AI, look what's happened to their dividend. It's now taking those steep increases, and that's because it's backed up by revenue growth. The more they can incorporate those rich licensing deals into the business, this should continue to go up. That means if you invest $5,000, because the stock price is so high, you're looking at about 22 shares. I'd say quarterly dividend around $12. Now you might be thinking, it's like the yield is nothing. Why would I be interested in this? But for me, I'm okay with a lower yield, 1%, 2%, because of this right here. Over 16 long years, that dividend growth rate is 4.43. Now, if you take a look at Canada's 16-year inflation rate, it's been at 2.4%. That means you're getting double Canada's inflation at 2.4% to 4.4%. That's double the rate of inflation. So you are in good company with TRI in terms of dividend growth rate. And if you take a look at the payout schedule, March, June, September, and December, as when you can expect those AI dividends. All right, let's finish off strong here with my next pick is Emera, ticker symbol EMA. Emera is a solid defensive holding with a low risk profile. And when it comes to building a successful portfolio, it's all about building complementary pieces. You don't want all attacking high growth picks like TRI. You want some high growth, you want some defense, good offense, good defense. And this company, this is a $13 billion energy and service giant that focuses on regulated electricity generation and electricity transmission services. The best part is management is committed to growing that dividend. Recently, management has provided annual dividend growth guidance of 4 to 5% through 2026, aligning with their 7 to 8% annual rate base growth. And rate base is very important when you're looking at electric regulated utility companies. Now, in order for them to achieve this goal, they have a $5.4 billion growth plan. In Q1 of 2024, their operating revenues and adjusted net income rose by 2.3% and 23.4% respectively compared to Q1 of last year. And the cool thing about investing in utilities is that they're known for their reliability. Think about it. When you walk into a dark room and you turn on that light switch, you're not hoping that electricity comes on. You're like 99.9% sure that if you flip the switch, the light will turn on, and lo and behold, the light typically does turn on. If you have a gas stove, you turn on the stove, you're not hoping that there's gas. You want gas for cooking needs. So that's what I mean. Reliability from their customers translates into reliability to their shareholders in the form of dividends. No one wants to see gambling when you turn on the light switch. Are you going to have power? You're not going to have power. Reliability is the game here. And the reason why I'm saying all this is that while they may not offer that explosive growth rate that you would see from tech companies, they offer consistent, reliable growth year over year, and that's not a bad thing. Honestly, I would rather turn on my light switch, knowing that there's electricity on the other side. I'm okay with that reliability. Plus, Emera also has a focus on clean energy, and that means that there is significant runway ahead because, as global metrics, there's more focus on those ESG deliverables. And if you take a look at the 17-year dividend growth streak, with a current yield of around 5.7%, that is well above its 5-year average of 4.9%. Again, because it's been beaten down because rising interest rates. But now, we're on the other side of those rising interest rates where interest rates are starting to come down. So if you've been looking for a bargain stock to add to your portfolio, take a hard look at Emera. Now let's take a look at the stats on my due diligence. Here we have Emera, ticker symbol EMA. Stock is just shy of $50 a share. As you can see now, it's getting closer to that 52-week high as the interest rates on the other side of those rises. 72-cent per share dividend, roughly around 7,300 employees worldwide, market cap of $14 billion. PE, I'm not too fussed about it, it's a regular utility. Very active on the TSX, and it's been around since 1998. And if we go back all the way to 2000, close to 24 years ago, in fact, that dividend was only 21 cents a share. 21 cents, look at this growth. Consistent, that's the beauty of, a reliable utility. 21 cents to 72 cents. Like, look at this. 24 years, that dividend just goes up, it goes up, it goes up, up. So $5,000, that's 100 shares, recorded dividend of 71.75, a yield of just under 6%, and a 24-year dividend growth rate of 5.25%. That's as dependable as you can get. And look at that, Canada's inflation rate for 24 years was 2%. So you're getting a leaps and bounds ahead of that inflation rate. 5.25 growth, 5.74 yield. I'm adding Emera all day, all night long to my portfolio. It pays off February, May, August, and November of each year.